everyone, I'm Maggie. You might have heard that the mortgage rates have been dropping like crazy, and it would likely be a shock to most since lower interest rates normally increases the prices of homes by a large margin. Well, think not, because today comes with a twist. It might actually lead to falling home prices. In today's market report, I will first show you the latest Seattle data and then discuss 3 risks that could cause prices to drop. Before we start, don't forget to subscribe to my channel. Let's first take a look at Seattle's local market in August. The typical home sale price in King County was $860,500, up 4.9% from last year. But hey, in comparison to July's $875,000, the price actually dropped by 2.85%. The price per square foot took the same path, up 1.34% from last year, but down 3.29% from July's $547. Although interest rates dropped by about 0.8% from May to August, economic and seasonal factors still led to a noticeable decline in home prices. The median days on the market in August was 10 days, up from 7 days last year, which indicates that homes are staying on the market longer. And this could be because many buyers expect further price drops or lower rates and are waiting for a better opportunity, especially since the rate cuts have only just begun. As for the new listings, there were 3,132 new homes in August, up 15.7% from last year but slightly down from July. This suggests that many sellers are also waiting to see the impact of the rate cuts, or they might plan to list next year. Active inventory in August stood at 5,447 homes with a supply of 2.8 months, up from 2.1 months from last year. While a supply below 6 months still indicates a seller's market, the increase in inventory hints at the possibility of price drops in the coming months. And this is the general data for King County, but if we look closer, the markets in different areas such as Seattle versus the east side showed significant differences. According to NWMS data, Seattle's inventory surged by 44.1% year over year, with a 3.3 month supply. Price increases were modest, only 2.9% compared to the last year. On the east side, like Bellevue, inventory grew by 12% with a supply of just 2.3 months. And this tight inventory caused a significant 11.5% increase in home prices year over year, especially for single-family homes in the 1 to 2 million range, which are selling quickly. These numbers reflect an imbalance in the market where some areas experience a shortage of inventory while others see an oversupply. On August 19th, during the Fed's annual meeting, the chair of the Federal Reserve, J. Powell, has indicated the time has come to adjust. Based on this, most institutions like lenders and media have confirmed that the Fed will likely announce a rate cut on September 18th, possibly as much as 0.5%. In fact, banks and lenders seem to have already reacted to Powell's comments, as the 30-year fixed mortgage rate has dropped to 6.35% in the latest week. Normally, rate cuts reduce mortgage costs, which is great news for buyers and those looking to refinance. But in the short term, it's hard to expect home prices to rise. It might even trigger a price drop. After talking with some finance professionals, I believe there are 3 main risks. First, the overall economic downturn. Although rate cuts reduce loan costs, if the economy is weak and unemployment rises, home prices could still fall. According to the latest report from the U.S. Department of Labor, only 142,000 new jobs were created in August. Seems like a lot to the layman's eye, but in reality, it is much lower than expected. It does not stop there. June and July job numbers were revised down, reducing totals by 86,000 jobs. While the unemployment rate dipped from 4.3% to 4.2%, the job market, especially in the cities like Seattle that rely on tech workers, remains fragile. Why? Well, most buyers have the habit of waiting during uncertain economic times, which, as you know, could lead to price drops. Second, the lock-in effect being lifted. As we've discussed many times before, the lock-in effect may cause many homeowners previously locked in by high interest rates to decide to sell, increasing housing supply. This could particularly affect non-core cities that have seen rapid price increases due to limited inventory. With the lock-in effect lifted, will there still be enough buyers for the additional inventory? Already, we're seeing home cities where homes are harder to sell. The final point is about buyer hesitation. Many buyers might think that since interest rates have just started to drop, they haven't reached the lowest point yet. So, like every profit-conscious person, they are waiting for home prices or rates to hit the bottom before making a purchase. This is why, in the early stages of a rate cut, demand from buyers isn't very strong and home prices may continue to fall. As our earliest data showed, although mortgage rates dropped from 7.22% in May to 6.35% in August, Seattle's available homes for sale increased by 13% during those 3 months, and prices per square foot dropped by 5 to 6%. Rates don't drop to the rock bottom overnight, and hesitation from buyers won't shift quickly in the short term. It is essentially being stuck between a rock and a hard place, and as a result, we may continue to see declines in the near future. Overall, lower interest rates are undoubtedly good for buyers as they reduce mortgage costs, but expectations shouldn't be too high. From 1971 to 2024, the average U.S. mortgage rate was 7.73%, and it's only in the last decade that we've seen the ultra-low rates of 4%. Many people hope rates will return to 4 or even 3%, but I believe that the era of good fortune is over, with the new norm for rates already projected to be around 6%. Finally, we have some advice for prospective buyers and sellers. For buyers, quite literally one of the most important parts of business, let's talk interest rates. If you haven't kept up with the real estate market or checked the latest rates in a while, I recommend reaching out to a mortgage broker. See what rate you can get right now. Mortgage rates are already about 0.5% lower than a few months ago. Simple. It means for a $1 million home, you could be saving $200 to $300 on your monthly payments, which drastically changes how high the eventual valuation of the house is. Next, consider refinancing. If you bought your home at a high interest rate in the past few months, ask your bank if you can refinance. Many banks don't charge any penalties for early repayment, so ask your bank or mortgage broker if you can refinance for free. This could help you save even more each month. When choosing a home, if your budget allows, I suggest looking at areas with high demand like Bellevue, Redmond, Kirkland, or consider single-family homes with larger, flatter lots. These types of properties tend to hold their value better than townhomes and condos. Finally, remember this: never time the market. The market might stay slow with more homes for sale, but right now, rates are down, inventories are up, and prices haven't gone yet. With buyers holding off, you could get a good deal. For sellers, let's start with the timing of listing your home. Interest rates have already dropped a bit, so if you're thinking of selling, there are 2 good windows to consider. The first is from September to October this year. Since rates have gone down, the market might see a small surge. It could be a great time to list your home. The second is from April to May next year. By then, rates may have stabilized and the market will be in full swing. This could be the best time to sell at the highest price of the year. Next, make sure to prepare your home before listing it. This includes things like minor renovations, staging, and taking professional photos and videos. Most buyers still prefer homes that are move-in ready. Simple upgrades, especially in the kitchen, bathroom, paint, can make your home more attractive and competitive. And to wrap up, always be prepared to adjust your expectations. The market is not the same as it was the past 2 years, especially in Seattle. With increasing inventory, even homes in popular areas may take longer to sell. If you really want a quick sale, you need to price your home reasonably. However, for single-family homes on the east side, the market is still very hot. With the right marketing and pricing strategy, you could still sell it at a really high price. And here's an interesting story to share. 2 members of my team actually bought their own homes for a few months ago. I asked them, why buy now when rates and home prices might drop further? And they said, first, it's almost impossible to predict how home prices change. It's really hard to time the market and buy at the lowest point. So if we see a good floor plan price, we go for it. Second, once you own the home, you have control, right? If rates go up, you are locked in. If rates drop, you can refinance. And many banks don't charge fees for refinancing now. Third, we bought a home we plan to live in, so the price wasn't a huge pressure for us. We just wanted to buy sooner rather than later. I think their decision was quite rational and they ended up with great homes. No matter how the market fluctuates, viewing more homes, understanding the market better will always lead to more informed decisions. I hope my analysis helps you better understand how rate cuts affect the real estate market and make the best decision for yourself. Lastly, if you have any thoughts on the current market, feel free to leave a comment below. See you next time.